you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Low Cost Funds. I'm Emma Wall and here with me today is Kenneth Lamont, Morningstar's passive analyst.
Hello, Emma.
Hello, Kenneth. So this week we've been looking at financial planning. We've been focusing on SIPPs, on pensions, on ISAs, on junior ISAs. And all of those portfolios need a core. Passives lend themselves really well to core holdings in a portfolio because there's certain qualities that passives have. But there's so many out there, ETFs and passive funds. How can investors sort the wheat from the chaff?
Well, that's a very good question, and that's where we come in. Most people would look directly at the TER, the total expense ratio, which is the management fee levied by the fund company. Although those serious about investing should perhaps look a little bit deeper than that. One thing that investors can look at is the tracking difference. This is the actual difference, the difference in performance between a fund and its index over time. And this is perhaps the best indication as to how well a fund tracks. Many people would look at this and see this as being one of the main or the most important elements of an ETF or a core ETF holding.
And you're going to give us some examples of funds that perhaps we'd like to hold in that core position. I thought perhaps we'd start with Better the Devil You Know, one that tracks the FTSE 100.
Well, it's a very, very popular index, as you all know. In fact, I believe yesterday, iShares announced that, the market leaders iShares announced that they've cut fees again. This is a very, very competitive market. And now for both their distributing and income share classes, they charge only 7 basis points as a management fee.
Is that your favoured fund in that sector then?
It certainly is. They have great spreads on the LSE and a great tracking difference over time. We really put our support behind these funds.
And perhaps going across the pond, the US has rallied significantly over the last couple of years, but it has had a correction recently, perhaps indicating a buying opportunity. If you are feeling positive about the US market, what's the best ETF in that space?
For this particular market, we really like the Vanguard S&P 500. It's very cheap fund, again at 7 basis points. It's very difficult to go wrong. It physically replicates the 500 stocks in the index. It's just very cheap and very efficient. We like it very much.
And perhaps then if you're taking a global outlook, for those who don't want to go too company or too country specific, which ETF is the best for that, for global equity exposure?
Again, for me, at this point, it's very difficult to look past the iShares Core MSCI World. This is a very broad index. iShares for this fund charge a TER of just 20 basis points for global equity exposure.
And it really does matter, doesn't it, cost when it comes to looking at passives, because that's going to be, over time, the differentiator between, you getting that index performance and you getting, over time, considerably less.
Absolutely. Even a few basis points over time will eventually eat into the returns you receive from your portfolio.
So 3 great low-cost ETFs for the core of your portfolio.
Absolutely.
Kenneth, thank you very much.
Thank you, Emma.
This is Emma Wall for Morningstar. Thank you for watching.